Greetings. Today is Wednesday, May 28th, and as the evidence continues to mount that the bottom is in, one of the things we want to talk about today is V-shaped recoveries. Two questions really. First is whether or not we regret getting defensive, and two, and more importantly, how do we handle that sharp ascent and sharp climb out? How do we get aggressive again? On the screen right now, I've got a monthly candle chart because I'm trying to show you the VSI reading. At the end of last month, the VSI had barely improved. Now remember, this candle chart is color coded based upon the VSI reading from the first of the month. If we flip the screen and now look at a weekly candle chart, every candle represents a week, you can just see how all of this played out. Our VSI indicator flipped back into a buy signal in the middle of this week. So that's where we stand right now. And so what do we do? How do we handle this? First of all, we do not ever regret getting defensive in our client portfolios. We believe our first responsibility is to defend the capital that the clients have worked so hard to earn and accumulate over their lifetime. Well, how do we handle getting back into an aggressive posture? Well, again, as we've discussed many times, in our quant strategies, we're going to follow the rules. If our quant models flip into a buy signal, we're going to buy. If they flip back into a sell signal, we're going to sell. It's really that simple. Why do we use two quant strategies? Because there's no such thing as a perfect quant strategy. They're going to turn on and off. They're going to flip on and off at different times. That is by design. What about our tactical strategies? That's where we're going to spend the majority of our time today. So before going any further, we need to explain that V-shaped recoveries are a blessing if you have no defensive tactical strategy. In other words, if your entire strategy is diversification and asset allocation and hope it all works out in the end, there's no defensive strategy. Therefore, V-shaped recoveries are a godsend because you just got saved. Conversely, I would argue that V-shaped recoveries are a curse if you have no tactical strategy, and in particular, if you don't understand portfolio math. And that's what I'm going to explain to you now. Before talking about position sizing, I need to make sure that you understand the first principle of portfolio math, and that is simply cutting your losses short, but letting your profits run. The reality is once you've allocated some of your portfolio to a position, if that position starts to move against you, you have no idea how low that's going to go. You have no idea how long that drawdown is going to be. So cut your losses short, but let your profits run. That's the first principle. The second thing that we need to understand is what's better. One trade with a 25% return? Most people would be pretty happy with that. But is it better to get 5 trades, each with an individual return of 5%, but you get to compound that gain into the next trade? Well, you do the math, the 5 individual trades of 5% compounded works out in your favor. This math, this principle of compounding gains gets even better as your average gain goes up. So let's redo the math. Now, instead of 5 trades each giving you a 5% rate of return, now let's assume you get a 10% return on each of those individual trades, and you can see that's a 61% rate of return. Make no mistake, I'm not suggesting that any of this is easy. I'm merely trying to help you to understand the math behind the portfolio decisions. Ultimately, one of the things that we want to get across is the reality is that you do not need to be fully invested at all times. You also don't need to be quote unquote diversified. We'll come back to that in just a minute. But first things first, our job is to protect the client's capital, and we do that by having very specific defensive strategies. But how do we take this math and help us to apply it back into an offensive strategy when we deem it appropriate to start taking risk again? So the last piece of the puzzle here is position sizing. So what do I mean by that? It's really just how much of your portfolio do you allocate to any position in your portfolio. So for example, if you buy stock ABC and you allocate 10% of your portfolio to that stock, if that position gives you a 25% gain, that is going to contribute overall 2.5% to your overall portfolio's return. Likewise, and this is where cutting your losses short really comes into play, if that stock that you buy gives you a 4.5% loss because you cut your losses short, that is going to hurt your portfolio clearly, but the damage is limited. Now, what if we increase the position size? Instead, now you put 25% of your portfolio in that individual stock. It gives you a 25% gain. Now it's going to contribute 6.25% to your overall portfolio's return. Conversely, if that stock ABC goes against you and you've got 25% of your portfolio in it, does it hurt your portfolio? Yes. But again, because you've cut your losses short, you've mitigated the damage. So the question is, how do we come out of cash in our tactical strategies? Well, the reality is we're going to begin to shift back into offense tactically with small positions while we gain traction. And so, for example, as we're coming out of a cash allocation, we're going to only do a 1% buy or a 2% buy or very small buy sizes so we gain some traction. Because if we are measuring risk incorrectly and the market moves against us and we take that loss, the damage to the portfolio is very, very minor. So as we are gaining traction in our portfolio, as we're gaining traction in our tactical strategies, we're going to increase the size of our trades. This is why we wait to increase our position sizing until after we're starting to see some victories. We're starting to gain some traction in our trading. This is also why we do not need to be fully invested at all times. If you understand the portfolio math and you understand the importance of position sizing and ratcheting up your exposure, that's why you do not need to be fully invested at all times. It's also why you do not need to be fully diversified. You could easily make an argument that you should not spread all of your assets over too many baskets. Instead, put your eggs in just a handful of baskets and watch the basket.